Thursday, August 26, 2021, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at how derivatives, and these are not financial derivatives, you will see what I mean in a minute, how they're going to come out again and rescue the central banks, Wall Street. Yes, they're using another type of derivatives now. I've spoken many times. I have even a derivatives file in one of my playlists. You can look at it. And I have spoken about how under a fiat currency system that we've had for the last 50 years, the central banks, the big Wall Street firms, the primary dealers, they use derivatives to manipulate, to inflate the price of assets like bonds, because derivatives gives them a lot of leverage, and they don't have to go into the underlying market. It's like the tail wagging the dog. Prior to 1971, yes, there were derivatives, but there were mostly natural commodity derivatives for people like producers and farmers to hedge against the climate and unforeseen disasters like frosts. Before I go into this new derivative, and some of you might already have guessed what it is, I'm going to talk about a great interview that, Coffee with Lynette. I've done Coffee with Lynette before, and she had George Gammon on yesterday. It's over an hour, but it's worth watching. And I have to say, I'm in 100% agreement with what George Gammon said. And he didn't really talk much about markets, gold, or things like that, and the economy. He spoke more about something really important, that without it, we can't really function in a capitalistic free society, where having gold, silver, or a portfolio of mining stocks or Bitcoin or cryptos will really mean nothing. And he's done a great job of using coded language, because as we know nowadays, the social media companies, they're doing the bidding of the globalists, and they will censor and delete you if you say certain things. So that's the slippery slope that we're going down. And I like to talk a lot more about this, but it's difficult. So we'll stick to the economic and financial and monetary aspect of things. I think it's more important than ever that we do have a little bit of physical gold and silver stashed away in these really, for us, it's for our generation, for younger people, and even older people, I think it's we're going through a war, and that's what it is. It's a war. It might we might not be seeing bombs fall off the sky. We might not be seeing news about soldiers getting killed in battles, but it is a war against us. I think it's a bit of an information war as well. So now to the new kind of derivative that's going to help or give the Federal Reserve and Wall Street an excuse to keep printing, to not really have to taper. So the article here in the FT talks about Jackson Hole. It's going to be a virtual meeting. It's going to start from tomorrow. Jackson Hole is organized by the Kansas City Fed. They call it a symposium. They always like to use these terms, the central bankers, to make it seem very academic, like they know what they're doing. And it's not just central bankers from the United States that will meet there, that usually meet there. It's central bankers from all around the world, major central banks. The last time they had a meeting, at Jackson Hole was in 2019. And I think that last real Jackson Hole symposium in 2019 was where BlackRock advised the Fed and other central banks to go direct, to pump their reserves into the real economy as well. And I recommend you watch an interview I did with John Titus of Best Evidence, where we talk about that. I'm going to put it up in the cards and in the description for you. So there's an article today in the FT, because Jackson Hole starts tomorrow, the virtual meeting, and it says, Fed prepares for virtual Jackson Hole meeting under cloud of Delta. So there you go. That's the new derivative. And it's appropriate because in the options market, I traded many options for my clients when I was a futures and options broker, especially towards the end of my career in the city, because futures, the commissions were getting really low, and we try to package option strategies where you have more than one leg, and the risk and the premium that clients would pay for those strategies would be quite small, so they could do thousands. That's how we kept our income. So let's say I would do what was called a put fly that had like 4 legs and cost like one tick. Instead of buying 1,000 futures of 10 years, they would buy a put fly in the 10-year for a tick. So they could do like 10,000 lots, multiply that by 4, that's 40,000. So I know about Delta. That's the Greek letter of the alphabet. And in the options world, we have Delta, which is basically the sensitivity of the option price to the underlying price of that derivative or that option. If a delta, let's say, is 50%, if the underlying instrument moves up a point, the option will move up half a point. It seems appropriate that the bankers and the central bankers, Wall Street, are using the Greek alphabet again for this crisis that we've had in the last 18 months. And is it any wonder that Goldman Sachs, which is part of this scheme, yesterday announced that people working in their offices in New York will have to have had the medical procedure, the double medical procedure, and even their clients, if they want to come into their offices, are going to have that. So what are the other Greeks for the options market? Well, aside from Delta and Theta, we have Gamma and Vega. And I think Gamma, if I'm not mistaken, Vega is to do with the volatility. So that's how it works. And it seems to be something that they're using for this crisis that we've had in the last 18 months. So the article says, scrapping of in-person event underscores risks as central bank debates when to dial back stimulus. So there you go. That's why it's given them another excuse. So I'm going to go through the article. I think it's important so you get an idea what I'm talking about, why I think they're using now the derivatives. And of course, it's not financial derivatives, it's health derivatives now, if you want to call it, to have an excuse to keep inflating the system and to have an excuse to say, well, we could not fight inflation because we had these derivatives come up. So it's written by Colby Smith in New York. It's dated August 26. When the Kansas City branch of the Federal Reserve announced in May that its annual gathering of central bankers would be held as an in-person event against the dramatic backdrop of the Rocky Mountains, it marked a milestone in the U.S. recovery from the depths of the You know what? I'm not going to use the P word. It starts with a P. At the time, the CV case counts in the US had plummeted as a nationwide medical procedure campaign accelerated. Major cities around the country opened back up, and Americans flocked to spend savings accumulated during the P on dining out and traveling. As a speedy return to normal life came tantalizingly into view, economic activity hummed in a way it had not for more than a year. Job gains and inflationary pressures were building at a speed that prompted the first of what would later become a chorus of calls for the U.S. Central Bank to begin assessing when and how it should scale back many of the emergency stimulus measures it rolled out last year. Well, actually, it wasn't right away that people called for the tapering, because the Fed was saying that the inflation was going to be transitory. But now, of course, we know that it's not transitory. And that's the reason why they've come up with a new derivative market, so to speak. It's because all the QE, all this monetary stimulus, it's to bail out Wall Street. And if they pare back the stimulus, the markets will collapse. And so they have to find an excuse, of course, and they have to play along with it. They have to cancel the symposium, the in-person symposium. They'll hold it virtually. But it's not the end of the world for these bankers, because they're playing along with the script, like Goldman Sachs is, in relationship to what they announced yesterday. But the Kansas City Fed's abrupt decision last week to move the Jackson Hole Symposium, which is held every August, to a virtual format for the second time in its more than 4-decade history, underscored the enormity. I mean, that word is pretty scary, isn't it? Trying to be scary. Enormity of the risks still confronting the recovery as the more contagious Delta variant spreads. So there you go. There's the derivative they're using. The U-turn also accentuated the high-stakes balancing act the Fed must perform as it charts its first policy pivot following a period of extraordinary monetary support, casting an even bigger spotlight on remarks from Chairman Jay Powell that are scheduled for Friday. They just face big, unavoidable uncertainty, said Bill English, a Yale professor and former director of the Fed's Division of Monetary Affairs. Well, very convenient that they ask a former Fed economist or director. We don't know what a recovery from a global pandemic looks like, how long it takes, and the longer-term structural shifts that come out of that. A robust economy with precariously high inflation that necessitates a hastier tightening of monetary policy was just as possible a year from now as a recovery that was partial and incomplete and slow, English said. So they're giving all the excuses, right? Officials at the central bank are engaged in an extensive debate about the fate of the $120 billion monthly money printing, they call it asset purchase program, unveiled at the onset of the Fed has said it will buy bonds at the same rate until it sees substantial further progress in its dual goals of average 2% inflation and maximum employment. Well, Federal Reserve, I've got news for you. The inflation, or CPI, that you watch is running almost at 6%, so almost triple that 2%. This tapering, well, not even tapering, the QE should have stopped, because tapering is not even stopping QE, it's lowering the amount that they do. They should have stopped QE altogether months ago. A growing cohort of central bankers have made the case that the inflation target has already been met and that the Fed should consider a more immediate reduction of tapering of its bond buying program. Well, again, I think this is just people of the FOMC, the members, playing good cop and bad cop. They know that they can't taper really that aggressively. So this is just to manage a perception of investors in the markets out there. It's pure propaganda. A choppier labor market recovery marred by worker shortages has unnerved other officials, meaning that Powell's speech will be carefully dissected for any hints on the potential timing of a pullback. It is one of the seminal moments each year where everybody's watching, said Mark Spindle, Chief Investment Officer at Potomac River Capital, a Washington-based investment firm. There are no immaculate tightenings, and now that they've admitted they're talking about tapering, they should redefine that talk and give us some insight on what they're going to do. Well, they want to know a bit more about the propaganda. Powell said last week that it was not yet clear whether the recent resurgence in COVID cases would significantly affect the economic trajectory. But in a sign of how delta derivative, derivative is the term I'm using here, but I'm adding on to it, has rattled even the most strongly held convictions. One of the most ardent supporters of a more aggressive tapering timeline, Robert Kaplan of the Dallas Fed, recently acknowledged the possibility that an adjustment may need to be delayed. Brian Sack, Director of Global Economics for D.E. Shaw Group, said he expected the Fed to signal in September its intentions to announce tapering at the November policy meeting, a sequence also predicted by Guido Persichetti, co-head of Global Treasuries Trading at Barclays. The actual taper would probably start in January, Persichetti said. It's amazing that they're going to announce their intentions in September, announce the tapering in November, and actually only started in January. You can see how they're trying to delay it there. As the Fed grapples with the tricky task of dialing back its stimulus, I think tapering, as I've said, and many other people are saying, is totally impossible for them to do unless they want to see a total collapse of the S&P and other stock market indices. Policymakers also face mounting questions about whether it can foster a more equitable recovery. So here they go over like how unemployment hasn't really improved for some of the low-income workers. I'm not going to go through that. But I'm going to come here towards the end because this video is getting a little long. And it's interesting that they come to a guy from BlackRock. And we know BlackRock is heavily involved in this whole scheme that we're seeing now. And watch that video interview I did with John Titus, and you understand why, going direct. So this is towards the end here. It says, one of the big unresolved questions is the extent to which monetary policy can be tightened in the long run, given current debt levels, which have soared to new heights following an unprecedented injection of more than $5 trillion in government stimulus over the past year. Well, don't forget the Fed's balance sheet either. A rise in U.S. borrowing costs that could accompany an attempt to normalize policy in the face of higher inflation was not a trivial matter against this backdrop. Boyden warned financial stability risks were also paramount, he added, made all the more acute by booming asset prices across a broad swath of markets. The taper discussion completely pales in comparison to a discussion of much bigger issues that we've been facing for the past 18 months. So there you go. There's the excuse. And will be for the next couple of years in light of what we're calling a policy revolution, said Boyden, now head of the BlackRock Investment Institute. So there you go. BlackRock is telling us there will be no tapering. BlackRock is in charge. So with that, let's quickly look at where the markets are this morning. It's almost 9 a.m. London time. We've got spot gold at 1786. It's down just under $5. Range has been 1792 to 1783.60. Silver is down 16 cents. So underperforming a little bit this morning. We're at 23.67. Range has been 23.89 to 23.59. Dow futures down 6. NASDAQ is down 28. S&P is down 5 points. FTSE is down 25 at 71.16. Currencies, we got sterling down 0.1%, 137.44. Euro is down slightly at 117.65. Dollars up 0.2% versus the yen at 110.20. Dollars up 0.2 versus the U1 at 648.13. Aussie dollar is down 1/4% at 72.56, and the dollar is up 0.2% versus the Canadian dollar at 126.10. And the Kiwi dollar is down 1/4 at 69.56. Kiwi dollar, of course, is the New Zealand dollar. To the commodities, WTI crude is down 1.4% at 67.30. High-grade copper is down 0.2% at 4.24. The 10-year yield is at 1.34. So we have jumped a little bit here. Yesterday, we were around 128, 130. So I think the markets are probably positioning themselves, especially the longer end of the Treasury curve, for this Jackson Hole speech by Jay Powell tomorrow. That's how important it's going to be for these fake manipulated markets. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.